All right, let's get right into it. Today, we're unpacking a monumental event that completely shook global markets, the 2026 Strait of Hormuz blockade. Analysts have been calling this the most significant energy shock since the 1970s, and for good reason. We're going to break down the exact timeline, look at how wildly prices reacted, and really understand why this specific crisis is forcing the entire world to rethink energy independence.
Okay, let's dive into this. We'll be using a 6-part roadmap to make sense of this massive geopolitical puzzle. We'll start with the physical choke point itself, move through the oil price shock, check out the spillovers beyond just oil, see who took the hardest economic hits, explore how markets actually managed to absorb the blow, and finally, talk about what comes next.
Part 1. The choke point. Why the Strait of Hormuz matters.
Before we can even begin to understand the global shockwave, we have to look at the physical reality of the strait. Picture this. It's a waterway just 21 miles wide at its narrowest point, sitting right there between Iran and Oman. It is, without a doubt, the single most important energy artery on the planet. On any given day before the conflict broke out, a staggering 20% of the world's seaborne crude oil and 20% of global liquefied natural gas flowed through this one narrow corridor. It's the primary exit route for oil coming out of Saudi Arabia, the UAE, Iraq, and Qatar, so it's a huge deal.
But then, in February and March of 2026, that massive flow completely paralyzed. And the crazy thing is, it didn't even require some massive naval armada to do it. Just the use of drones, missiles, and small, fast attack boats created an environment of such high risk that maritime traffic dropped to near zero practically overnight. We saw 20,000 mariners suddenly stranded in the Persian Gulf. And for the few ships brave enough or desperate enough to actually attempt the transit, well, war risk insurance premiums absolutely skyrocketed to between 0.2% and 0.4% of the ship's entire value. Plus, there were these exorbitant transit fees of up to 20% being levied. So, for a very large crude carrier, you're talking about a sudden extra $250,000 just to get through. Moving right along to Part 2, the oil price shock, the roller coaster of 2026. That sudden paralysis triggered the largest oil supply shock on record. We're talking about pulling roughly 10 million barrels of supply per day out of the global market. And the timeline of what followed reads like an absolute roller coaster. In March and April, the market just completely panicked. Brent crude spiked aggressively, surging past $120 and legitimately threatening the $150 barrel mark. It was literally the fastest monthly price increase on record. But then we hit June. A temporary, super fragile ceasefire agreement was reached, and we saw a dramatic reversal. Tanker traffic briefly resumed, and prices basically erased all their wartime gains, tumbling all the way down to roughly $68 a barrel. But, as we know, that relief was incredibly short-lived. By July, the ceasefire fractured, the blockade resumed, and boom, prices surged right back up. Now, what's really fascinating about that July resurgence is how differently analysts tracked the immediate impact. The International Energy Agency, the IEA, reported that dated Brent was trading around $77 a barrel right after those July breaches. But simultaneously, other major market analysts and commodity indices noted that the renewed blockade had pushed target prices rapidly back up into the $83 to $85 range. Regardless of which specific daily print you look at, it proved one thing: the market was hypersensitive. It was violently swinging by $20 to $30 a barrel based entirely on the daily, sometimes hourly, geopolitical status of the strait.
Let's look at Part 3, Spillovers Beyond Oil, the commodity cascade.
Now, what's really interesting here is that the story definitely didn't stop at the gas pump. The energy shock instantly cascaded through the entire global supply chain, threatening everything from the food on our tables to the technology in our pockets. Just look at the stark forecasts coming out of the World Bank. While overall commodity prices were projected to rise 16%, the agricultural sector took an absolutely devastating hit. The Gulf is a major hub for global fertilizer exports, right? So with those shipments blocked and LNG constrained, the World Bank projected fertilizer prices to surge 31%. That was driven by an unbelievable 60% jump in the price of urea alone. And look, this isn't just numbers on a spreadsheet. A shock like this erodes farmer incomes and drastically reduces crop yields globally. The World Food Program actually warned that if this dragged on, it could push up to 45 million more people worldwide into acute food insecurity.
And the dominoes just kept falling across other markets, totally aligning with the grim IMF commodity outlooks we saw. European natural gas surged by up to 45% early in the crisis, since Qatari LNG was blocked. Base metals that are absolutely critical to the energy transition and AI data centers, like aluminum and copper, hit all-time highs.
And as you might expect when global stability is threatened, investors ran for safety. Safe haven precious metals, especially gold, were forecasted to see average price increases of 42% on the year.
Which brings us to part 4. Who gets hit hardest? Uneven global damage.
While the shock waves were felt all over the world, the actual economic pain was incredibly uneven. On one hand, advanced economies showed some surprising resilience. The IMF actually revised global GDP growth for 2026 to a relatively stable 3%, which is higher than the previous few years. A lot of that was because massive AI-driven demand helped offset the negative effects of the oil shock in the broader market. And the U.S. economy, which is largely insulated by its own massive domestic energy production, avoided recession entirely. But the pain was acute for developing importers. The IMF's regional breakdown specifically highlighted the MENAP region, that's the Middle East, North Africa, Afghanistan, and Pakistan, along with the Caucasus and Central Asia. They faced sharp export curbs, significantly weakened growth, and skyrocketing costs for everyday essentials.
So, the crucial point boils down to one specific number, 5.1%. That is the inflation rate forecasted by the World Bank for developing economies in 2026. That's a full percentage point higher than pre-war expectations. It basically means the poorest, most vulnerable nations are the ones effectively paying the highest price for the blockade.
Part 5. How markets absorbed it. Surprising resilience.
This leads us to a massive yes, but for the global economy. Yes, this was the largest oil supply shock on record. But no, the global economy did not totally collapse. So how did we avoid total disaster? Well, as highlighted by energy expert Daniel Yergin and Bloomberg Intelligence, the market deployed some massive strategic cushions. First, the U.S. had significant inventory buildups and authorized massive coordinated releases from strategic reserves alongside the IEA. Second, China tapped into its massive onshore inventory, estimated at around 1 billion barrels. Third, countries actively scrambled for bypass routes, like Pakistan routing oil via the Red Sea port of Yanbu. And fourth, we saw extreme demand destruction over in Asia. Fuel was heavily rationed, refineries ran at severely reduced rates, and commercial flights were completely cut just to save energy.
And finally, Part 6. What comes next? The fragile future.
Now, while the market survived that initial blow, the current state of global energy is incredibly precarious. The IEA's numbers brilliantly illustrate exactly how deep of a hole we're in. Even as things bounced back a bit in June, world output was still a massive 9.4 million barrels per day below pre-war levels. The report noted that global oil supply was on track to decline by an average of 3.7 million barrels per day for the entirety of 2026. The market is effectively holding its breath right now, deeply contingent on transit volumes improving and hoping for a swift de-escalation.
And the data reveals exactly what happened when that June ceasefire offered a glimmer of hope. Benchmark prices literally spiraled lower, plunging $22 a barrel month over month. It proves just how hyper-reactive our global economy is right now. Because the moment the ceasefire broke down on July 7th and 8th, all that optimism vanished in an instant, and the intense pricing pressure returned immediately. Which leaves us with one final, absolutely critical question. If the ceasefire continues to fracture, how long can the global economy rely on finite strategic reserves to prevent a historic crisis? We've managed the shock so far through emergency stockpiles, demand destruction, and pipeline bypasses. But let's be real, these are temporary band-aids. As discussed in a recent heat map interview with energy expert Jason Bordoff, the 2026 blockade has sparked serious, urgent global conversations about the need for long-term energy autarky and aggressive diversification. The Strait of Hormuz has shown us exactly how fragile our supply chains truly are, and the world is now on notice. Thank you so much for joining me for this explainer. Keep asking questions, and I'll catch you next time.